Well, China is considering approving $1.4 trillion in extra debt in the next few years to prop up its economy.
The biggest global story of this week really has been the non-stop rally in the Chinese market.
Well, the Chinese markets have been pretty silent since COVID, but in the last 1 year, China has seen an interesting rally, and investors globally are now looking at China as one of their diversification hubs. But many still consider China to be the world's most uninvestable stock market. But here is what Harvard Marks, who's from Oaktree that manages $202 billion, had to say about this.
Many people in the investment community describe China as uninvestable. To me, that word is music to my ears.
And he further stated that I have made my own career out of such opportunities, and at the moment what China is offering is a bargain. It doesn't mean you have to buy everything, but definitely look for cast-offs and bargain. Now, picking individual Chinese stocks might not be the best bet, given that you don't know the companies there. But if you still want exposure, then US-based Chinese ETFs can give you a balanced exposure to the Chinese markets. Now, in this video today, we are going to cover the Chinese-focused ETFs along with their performance trends, along with the various opportunities and risk involved. Before we dive into 4 ETFs that you can explore, let's understand what is an ETF and how these ETFs track the Chinese market. ETFs, or exchange-traded funds, are investment vehicles that allow you to own a diversified basket of stocks through a single trade. When it comes to China-focused ETFs like NCHI, KWEB, GXC, and FXI, they track different segments of the Chinese equity market using a mix of A shares, H shares, and US-listed areas. Now, A shares are stocks which are listed on the mainland Chinese exchanges like Shanghai and Shenzhen. H shares are Chinese companies listed on the Hong Kong Stock Exchange. ADRs, which are known as American Depository Receipts, are Chinese stocks listed on US exchanges like NYSE or NASDAQ. Now, each ETF has a different exposure mix. For example, NCHI and GXC offer broader access across all types. KWEB focuses primarily on US listed tech ADRs, and FXI leans heavily into large cap H shares. The structure allows global investors to participate in China's growth story without directly trading on local Chinese exchanges. The first one is the iShares NCHI China ETF, which offers exposure to large and mid-sized companies in China. Now, here's the comprehensive overview of the same. As of April 2025, this ETF holds 563 companies. Under this ETF, the majority shareholding is of Tencent, Alibaba, and PDD Holdings. It's one of the most diversified China-based ETFs that gives you exposure to tech, finance, and consumer goods. Now, coming to its past 3-year performance, in 2022, the ETF experienced a decline of approximately 22.53%, and in 2023, the downward trend continued with a further decrease of about 11%, influenced by the ongoing economic and regulatory factors. But in 2024 marked the positive turnaround, with the ETF achieving an 18% gain, indicating a recovery in the market. In fact, the last 1 year return of this ETF has been 27% and has beaten the category by nearly 4%. Now, there are 3 reasons for you to consider this ETF. NCHI has delivered a year-to-date return of over 14% as of April 2025, indicating a sharp recovery after years of underperformance. For long-term investors, this creates a buy-low window to tap into China's structural growth story. Access to 11 different sectors, which means diversified exposure to China's key growth drivers. Now, the second ETF that we're going to discuss today is the iShares China Large Cap ETF FXI. Now, this particular ETF focuses on 50 of the largest Chinese stocks traded on the Hong Kong Stock Exchange. Long story short, this ETF belongs to the blue chip companies of China. Now, under this ETF, the majority shareholding is of Tencent, China Construction Bank, Meituan, Ping An Insurance. This ETF is heavily tilted towards the financials and the state-owned enterprises. Now, coming to its past 3-year performance. In 2022, FXI saw a big decline of 20% amid global rate hikes and domestic economic slowdown. In 2023, it fell even further by almost 10% due to weak consumer sentiment and concerns related to state-owned enterprises. But in 2024, it saw a healthy comeback with more than 15% returns on renewed investor confidence. And in 2025, year-to-date, as of April, the returns that it has generated is almost 12.7%. FXI by far has been one of the best performers when it comes to the Chinese ETFs in the last 12 to 18 months. And here are the top 3 reasons for you to consider this particular ETF in 2025. Now, FXI offers access to China's most stable and globally recognized blue chip companies. The ETF has rebounded with over 12% year-to-date returns, highlighting renewed foreign investor interest. Less tech-heavy composition makes it relatively resilient during the tech sector volatility. Now, these are the three reasons for which you can consider this particular ETF. And now we are moving to a third ETF, which is SPDR S&P China ETF GXE. Now, GXE provides investors with a broad-based approach to owning Chinese equities. GXE gives you the exposure to over 800 Chinese companies across all market caps. Long story short, this ETF is the most diversified way to own a piece of the China Inc., from tech giants to banks and industrials. Now, under this ETF, the majority shareholding is in Tencent, Alibaba, and Meituan. It's one of the broadest China-focused ETFs, giving you exposure to tech, finance, consumer goods, and beyond. Now, coming to its past 3-year performance, in 2022, it dropped approximately by 21% due to broader economic challenges and investor uncertainty. In 2023, it continued downward pressure with a decline of almost 11% amid mixed macro signals. In 2024, this ETF recovered by almost 17.3%, given the improved policy stance and economic data. In 2025, year-to-date performance stands at 13.5% as of April. Now, here are the top 3 reasons for you to consider GXE in 2025. Number 1, broad-based exposure. With holdings in over 800 companies, GXE offers unparalleled diversification across China's equity landscape, minimizing your concentration risk while capturing sector-wide growth opportunities. Recovery backed by fundamentals. Now, after years of drawdown, GXE's rebound reflects not just sentiment shift, but also improving macro indicators and corporate earnings, signaling a potential inflection point in China's equity cycle. Number 3, strategic sector allocation. A well-balanced mix of each, of tech, financials, industrials makes GXE a compelling core holding for investors seeking long-term China exposure without overly relying on one single growth engine. Now, the last ETF for the day that we're going to discuss is the Crane Shares CSI China Internet ETF, popularly known as KWEB. Now, this one gives investors targeted exposure to China's booming internet and e-commerce sector. This ETF is actually a gateway to China's fastest evolving digital economy. It focuses entirely on the internet and tech-enabled companies, think e-commerce, fintech, online media, and cloud services. This ETF is a concentrated bet on the futures of China's internet giants and their rebound potential. Coming to its past 3-year performance, this ETF saw a huge decline of more than 25% due to China's tech crackdown and geopolitical tensions affecting the investor sentiment. In 2023, it declined by another 12%, but in 2024, it has given a rebound of almost 18.4%, signaling market optimism and recovery in the internet sector. In 2025, year to date as of April, they have given a return of almost 14.75%. Now, here are the top 3 reasons for you to consider KWEB in 2025. Now, given that this has already given a year-to-date return of 14% in 2025, it has shown very strong momentum with China's internet space. Number 2, long-term investors get access to undervalued high-growth internet giants with improving regulatory clarity. Number 3, the ETF's focus is entirely on the digital economy, which is expected to be the key engine of China's growth story going forward. Now, next, we are going to discuss some of the risk involved in the Chinese market as of now. Before considering to invest in any of these ETFs, you should ideally be knowing the kind of risk you're dealing with. Now, number 1 is the regulatory uncertainty. Now, the reason why world calls China markets uninvestable is because of the sudden regulatory changes that are deployed overnight, and they do hold the potential of affecting the outlook of an industry, economy, etc. However, it does look like that the Chinese government wants to avoid this now, given their plans of quantitative easing. They do want the Chinese investors specifically to invest in stock markets, as the real estate sector is in a slump and they don't want the Chinese money to flow out in other countries. Number 2, the geopolitical tensions. Since Trump has taken over the US presidency, he has made it pretty clear that countries globally will have to welcome tariffs, and this will impact Chinese exports to a fair extent. Now, in order to mitigate this as an investor, you can choose ETFs which are Hong Kong listed, for example, FXI and GXE. Number 3, the concentration risk. Now, this is an important one. You must not assume that all ETFs available are highly diversified. On the outside, they may appear diversified, but when you study the majority holdings, you realize that most of your money is going towards 3 to 4 stocks. Now, idea here is to pick ETFs such as NCHI, GXC, which have exposure to hundreds of companies rather than just 4 or 5 major companies that drive the valuation of the entire ETF. Now, the final thoughts. Yes, Chinese ETFs do look cheap. Yes, the upside looks attractive, but this is not a story of quick wins. It's about being patient, calculated exposure to the market, undergoing structural change. Approach this space not with FOMO but with foresight. The stimulus and quantitative easing being done by China right now does indicate that shifting your 5 to 10% of your portfolio there can lead to healthy returns in the long term. Understand the risk, diversify intelligently, and align your China exposure with your overall global portfolio strategy. Tell us in the comments what you liked about the video, how we can improve, and what you would like to cover us next.